So today we are here for key investing concepts. Something that I know I personally was like, huh, that's right. When I was looking through sort of the presentation and what was going to be shared today is that I'm actually investing and I didn't even realize things like my retirement account. I'm investing. I didn't realize I was an investor. So like it's crazy to think like your investment journey can look so different. I feel like a lot of times we just picture like the crazy like stock market and day traders, but that doesn't have to be what your journey looks like. And so I think I'm really excited for today to kind of learn like a lot of the foundational pieces of what investing entails and how that might fit into my own life and hopefully help you see how that fits into your life. So today, just a quick rundown. I'm just going to go over some of the things we're talking about as I am. A quick call that this webinar will be recorded and all attendees and everyone who registered will receive a copy of the slide deck as well as the recording. And then the recording will also live on a Vimeo account with the rest of the lunch and learns. Also just something to keep in mind in the Q&A section that anything you are sharing is going to be in that recording. And then I'll do a quick introduction of John, hand it off for the meat of the presentation, and then we will have time for a Q&A at the end. If you have any questions throughout, please feel free to drop them in the Q&A box. Some of them we may get to during the presentation, and then some of them may be saved for the end. If we don't get to it throughout the presentation, we will definitely get to it at that end section. And you can also always reach out to us for any follow-ups. I also want to share that because of the webinar format, we're not able to use the chat box. So please feel free to use the Q&A box as you would with a chat. You'll have the ability to see other folks' questions. You can upvote and comment on them. So feel free to engage in that way there. And I'll start with introducing, as I mentioned, John Pelletier, who's the director of the Center for Financial Literacy at Champlain College since its creation in 2010. So really there through all of that history. John and the center have been recognized nationally by the White House, Consumer Financial Protection Bureau, Financial Literacy Education Commission, national media, local media, really all over for the center's unique teacher training programs, research, and advocacy. And just really honing in on the importance of financial literacy. And that's what we're looking at today. And then prior to the center, John was a chief operating officer and chief legal officer at some of the largest asset management firms in the US. So really having a diverse background in this field, which I think is really helpful in kind of the approach and the knowledge base. John Pelletier is also currently an independent trustee for the Transamerica Mutual Fund family and has a JD and MA in public policy from Duke University and a BA in economics and political science from Assumption University. And we are very, very glad to have him here now with us at Champlain College. And without further ado, I will send it off to John. We're just going to do a quick change and share screen, so bear with us on the tech for that. And we'll get started on the presentation.
Okay, I'm going to share. Hold on. Hopefully this works. And
see it on our end.
good. Are we up and running on your side? You can see that?
Yep.
Good. Okay. Thanks, everyone. So we're going to talk about key investing topics today. Hopefully you'll find this interesting. And the first thing I like to talk to people about when we talk about investing is it's not savings, right? So let's go over a little bit what the difference is. Savings is when you're putting money aside that you need for the short term, and you really can't take risk of investment loss, right? You want to, whatever you put in, if you put $1,000, your goal is to make sure that 1,000 plus a little bit more is available, not that it's maybe $800. And so, when you need that money, right, think about it like a rainy day fund, an emergency fund, right? Or maybe you're saving up for a mortgage down payment, or you're saving up for, a down payment or an entire purchase of an automobile. Maybe it's a vacation. that you plan on taking, or maybe a holiday fund. That's savings, and you're going to generally put that in a bank savings account. If you want a little bit higher interest rate, maybe you put it in a money market fund, or into a CD. And all of those kind of savings scenarios, you're not going to lose money, right? You're putting it in your principal's pretty much safe, and you're looking to add interest onto it. But when you're investing, certainly beyond a 5-year period, or some might even say a 3-year period, when you've got a lot longer time period before you need the money, retirement is the perfect example of that. That's I'm sorry, is a perfect example of that. You don't maybe need it for 20 years, right? Or 15 years, or whatever it may be. So you want that to be bigger, and you want bigger returns on that. But I mean, the main objective of investing is to really increase and grow your wealth, right? And also to make sure that you're protecting your purchasing power against inflation, right? And we'll talk a little bit about inflation, but inflation, you always want your investments, and frankly, if you can get it, your savings to have a rate of return in excess of the current inflation rate, so that your purchasing power doesn't diminish, so that you don't have to buy, that you're able to keep up. When it comes to investing, probably the first thing you need to think about is your risk tolerance. You really want your investing to um, meet your emotional state, if you will. I mean, we're all emotional with investing. Some of us, we're willing to take more, accept more portfolio risk, right before we have issues. We all have a fight or flight gene, right? It's back from the caveman days, and what we find is it really shows itself in periods of dramatic financial decline in the markets. Stock markets crash, right? A bear market means that from its high, the stock has dropped by 20% or more. Um, when we had the crash that occurred in 2008, right? That giant crash, the global financial crisis, that was greater than 50% if you were invested in the S&P 500 in a very short period of time. It recovered, right? Within less than 3 years, you were back where you were. But a lot of people, when they see that, they get very anxious, and they go, I've got to sell everything and get into cash. And so they take all the pain of the downside, but you might miss the upside. There are other things, and so you need to really get a handle on that. Can you deal with a 20% loss in a year? Can you deal with a 30%, 35%, 40% loss? Because if you can't, you really want to put your portfolio mixed with assets that, based on history, are more likely, won't get you to sell when you shouldn't, and then buy in when you've already missed the upside. Because a lot of people, when they invest, they tend to sell when the markets are low and invest when they're high, and that's not what you want to do. You want to buy cheap and sell at the top. So factors that influence our risk tolerance, our own financial situation, right? We don't have a lot of money in the bank, you may have more fear of losing even small amounts versus somebody who maybe they're in their 40s and 50s, and they have net worth in their house, and they've been putting money into their retirement plans for years. They're in a different situation. So your individual financial situation, the longer it is till you need the money, if it's in your retirement plan, and you're even though it dropped terribly, you're better off doing nothing, as painful as that is psychologically. If it's, retirement is 30 years away, it'll recover. But people don't do that. They react emotionally, and that's very normal. And so it all comes down to your personal preferences. And then what's your goal, right? Are you looking to dramatically increase your money through growth of those assets and wealth? Are you looking to preserve your existing wealth because now you're 70 and you're not worried about growing it? You just want to don't lose, you don't want to lose much of it because you don't want to run out of money before you die. And so this changes constantly based on where you are in life. But generally you fall into three categories. You're either conservative, and you don't want a lot of risk of loss at all. You have a moderate kind of approach. You can take some risk, but not too much. Or you could be really aggressive where you're fine with big losses because you're willing to have long-term rewards. I would recommend if you search investment risk tolerance and test the University of Missouri. You can take a grade free test online there that I think will give you an idea of what category you fit into. But before you invest, kind of figure out what type of investor am I? How much risk am I personally emotionally comfortable with? Make sure you're investing ties into your risk tolerance, your emotional state. And again, we all have different emotional states when it comes to investing. And there is no wrong one, there's no right one, there's just yours. And try to invest consistent with that. So let's talk a little bit about the trade-offs between risk and return. Really, 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 really simple, right? The greater the return of your investment, the higher the risk. That means that the amount of loss is likely to be much greater. So, the worst bond loss year we ever had was a few years ago, and that was around, I think, 12 or 14% in the bond market because there was such a quick increase in interest rates. We'll talk about how bonds work. Whereas the worst loss that you could have had in say, a stock market crash is, in excess of 60% in the Great Depression. But a good one would be 2008. Top to bottom on the S&P was in excess of 50% loss. So that gives you kind of a range of losses. The types of risk you got to worry about is volatility. Stocks prices jump up and down a lot more than bond prices generally. For example, CDs don't have any volatility, right? A certificate of deposit or a savings account. um, um, and the other thing is inflation. You want to try and get a return that will beat inflation. That was really hard to do in the past, 2 to 3 years, to on certain investings to beat inflation. The black swan risk, the unknown, right? Maybe it's a war, right? There could be a war. COVID, it was an unknown risk, and those things when they occur impact the market, right? I mean, they just do. I was shocked at yesterday's market activity. We had one of the highest days in the equity markets, probably in 2 or 3 years, in response to the election, because the assumption being that Trump will be good for companies, for example. So you have these kind of crazy things that you can't predict any result, but markets react the way they react. Liquidity risk is another risk, right? Where that's like Bitcoin can be a little bit the cryptocurrencies liquidity risk. Or I know of some young people who reached out to me. They were interested in a startup that was raising 65 million from small investors and promoting on Facebook and Instagram. It was a startup company where you're allowed under the law now to be a private investor in these smaller startups. Minimum investment I thought was $100, but that money is liquid until they go public, right? So it's about as liquid as it gets. You can't sell it. They either have to do an initial public offering to eventually allow you to have liquidity and to be able to sell your small investment in these companies, or they might go bankrupt and you lose all your money. It's very startups, tend to be very, very risky. So this chart is a really good way of getting your head around risk versus reward. And I do want to talk just really quickly about
I have a
speculation.
quick
Yep, is there a
question.
question?
So I know you were talking about what liquidity is. When you say something is liquid, what does that mean?
Yeah, think of Apple stock, right? Giant company, Meta, right, which is Meta or which is Facebook or companies like that or Amazon. You can sell your stock any day you want, but for example, GameStop, which was a meme stock investing, which is actually ties very well to this. That's a very small company. It doesn't have a lot of shares. It's not very big. It's considered a small capitalization company. And so it's a small cap stock. Doesn't trade a lot of shares every day on the market. And so if everybody sells at once, there's not enough buyers. And so the prices can drop on small caps because there's a lot less shares and buyers and sellers, that when everybody wants to get in and or out, the volatility is higher than say an Apple or a Tesla or these giant $1 trillion plus market capitalization companies. So I mean, so we have multi-trillion-dollar companies out there where you take the share price times all of the shares that people own, and we have companies that are almost 4 trillion in worth $4 trillion. Think about that, right? So we have quite a few companies, not that many, over $1 trillion in market capitalization, which is just simple math: number of shares times the stock price. There are companies that are very tiny; they're only $1 billion, and so those are huge differences. And so when you're buying and selling, that's what happens there. Speculation is a little bit different, right? And the greatest example of speculation I can think of is tulip mania from the 1637s. It's the first bubble. People actually traded tulips, and there were futures on tulips. Tulips were rare in Western Europe. They came from the Ottoman Empire, and people thought they were these wonderful, rare things of beauty. You can buy a tulip today, a single bulb, for probably less than $1. But what would the most expensive tulip be worth? The Gouda was a very rare type of tulip with all these multicolors in it. What would that have been worth in 1637? It would have been worth all of these things, right? The equivalent of 80 bushels of rye plus 4 fat oxen, another 40 bushels of wheat, 8 pigs, 2,240 pounds of butter, 12 fat sheep, 1,000 pounds of cheese. These are all the price of these objects in florins. If you added up all of these, this is what you could have bought with one tulip. And that one rare tulip was in Amsterdam equal to a row house, right? Like a 3-story row house was the price. Things went excessive. They went very quickly, right? So here's the price of the Gouda in Guilder, which is another currency that when these traded in. Look at that. In 1637, it skyrocketed from under 10, to 60 and then down again. These are examples of speculation and we experienced a similar curve of this nature in the housing bubble. The same was true in the tech bubble of 2020, of 2000 rather, which burst in March of 2001. So speculation is a little bit different. I refer to it as the greater fool theory. I'm willing to pay a high price for something on the belief that I can sell it for an even higher price. It's not investing as much as people are making very speculative bets about the future value of something. And particularly in the tech bubble, a lot of the companies that were selling at crazy prices, they weren't even profitable, which is very different than tech companies today, which are very, very profitable and the bigger ones and have all sorts of cash. Want to get on to bonds. I'm trying to be cognizant of time here. Bonds is so when you're again thinking about the risk spectrum, money market funds and CDs are the lowest kind of risk, right? Lowest volatility of price, lowest risk of losing any money. Bonds are next on that scale, right? You're going to get a little bit more. So, right now you could probably get anywhere, depending on how risky of a set of bonds you bought or a bond mutual fund, you could probably get anywhere from 6 to 9% returns on them, but they fluctuate. And what makes bonds interesting is what makes them fluctuate is the interest rate market. And the biggest factor that drives interest rates is inflation, right? Because people who give their money to a bond is nothing more than, it's basically a loan to a company, right? If they're issuing bonds, or to the federal government or the state government. So we have, treasury securities, the government issues bonds. If you buy a treasury security, you're giving the federal government a loan. If you buy a Vermont municipal security, you're giving the state of Vermont a loan. And they're promising to repay you. And they usually are priced in $100 increments. It's called par. The par of the bond is $100. And they're agreeing to pay you back the principal at some future date. It could be 5 years from now, 10 years from now, 30 years from now. But while they hold on to your money, they're going to pay you interest rates. And the longer the term of the loan, the higher the interest rate you as the borrower gets. So you're going to get a much higher rate on a 30-year mortgage than you, right, on a 30-year bond, for example, than on a 5-year bond from the U.S. government. Or in the alternative, the other way to think about it is how creditworthy are these people? So if you've heard of so there's high yield debt, right? Instruments, junk bonds, if you've ever heard that phrase before. Those are companies that you're going, they're a little bit below investment grade. There's a risk I might not get repaid. The other thing about bonds is if a company goes bankrupt, bondholders, if you loan money to a company and you get a company bond in return, or a municipal entity, the assets held by that company have to be liquidated and paid out to the bondholders before shareholders in the company get anything. So in bankruptcy, what we find with bonds is that you generally get 60 to 70, 75 cents on the dollar if a company files for bankruptcy. So, like Hertz filed for bankruptcy. If you own their bonds, actually, in that case, I think, got paid 100% of your money back. But once they file bankruptcy, they stop paying interest. So until the bankruptcy is resolved, you're losing the interest on your money. But the key thing to remember is bonds follow interest rates, right? So when the Fed is doing things with interest rates, when interest rates rise, when they go up, right, which is what we experienced a few years ago, the value of bonds drop. It's inverse. That's all you got to think about it, is when interest rates go up, the value of bonds go down. When interest rates go down, the value of bonds go up. So it's tied to the interest rate. And the reason is, if you want to sell a bond today, they're going to say, well, what's a brand new bond being issued today worth? And so when you bought a bond, it was paying a 3% interest rate to you. But today, somebody investing money in the bond market is expecting 4% return. Well, the value of your bond has to go down in order for that 3% return to equal the 4% market rate. So that's kind of, bonds is something that a lot of people have trouble getting their heads around. But if you can remember this inverse relationship, that will be helpful. One thing when you're looking, particularly at like a bond mutual fund, if you're trying to understand how risky is this bond mutual fund, when you look up, there are these fund fact sheets, for example, or you can look, if you're buying individual bonds, you can do some research. find a thing called duration. It tells you how sensitive your investment is to a change in the bond market. And so an example would be if your bond duration, which is it's not identical to how long the bond period is, but it's pretty close. So if I have a longer duration of say 8 years, then a 1% increase in a single year of interest will mean I lose 8% of my bonds. And that's pretty close. A lot of bond funds, if you look at the right-hand side of your screen, there's a thing called the Bloomberg US Aggregate Bond Index. A lot of bond funds, that's their benchmark. And you can see that has a 6.77 year duration, which means whenever interest rates go up by 1%, you'll have a 6 to 7% loss, right? And so that gives you kind of the sensitivity. And again, below you can see what happens and how duration impacts the value of your bonds. So if you in each case you start with 1,000, but if I have a 10-year bond and there's a 1% change in interest rates, when I go to sell that bond, which I paid 1,000 for, I'm only going to get $900 for it. But if the opposite happens and I have a 10-year bond and interest rates go up by 1%, I could sell it for 10% more than I bought it for. So that's the thing to get your head around on bonds. The other thing when thinking about bonds is understand that it's tied to inflation. So the blue line on this chart is the 10-year Treasury yield rate. And actually, they went up because the expectation is that there's going to be more debt issued by the US government under Trump yesterday, after the election, and that there's going to be more inflation because the tariff policy he has is actually very likely to increase inflation at least over the short run if it's implemented. So you can see here on September 30th of 2024 on this chart, the 10-year yield if you invested in that bond, you'd get 3.81%. As of yesterday, it's almost 4.5%. So it jumped up quite a bit in reaction to the election. And the same way the stocks. So in this case, it was bad for bonds and good for stocks yesterday. It was a very volatile day. And you can see the key point is look at the way these charts, they're not identical, right? But you see how they're aligned? When one goes up, the other tends to go up. When one goes down, the other tends to go down. So if you keep your eye on that 10-year Treasury rate, it gives you a good idea of what bond pricing is doing. And the important thing about that 10-year rate is that 10-year rate determines, it's the base benchmark that's used for, say, a 30-year mortgage rate. So you can see why mortgages were so low during COVID in 2020 and why they're much higher now. You have to go back to like 2006 to see mortgage rates that are somewhat similar to what we're experiencing right now. So they haven't been that high in a while. I've been around a long time. I can remember when they were over 10% on a 30-year fix. I know they seem high now, but I've certainly experienced higher in my life. So let's jump to stocks. What's a stock? A stock is literally, you're an owner of a company. It's a publicly traded company. You buy it on a stock market. When you think about companies, they're either large cap stocks, right? Those are probably 100 billion and more of market capitalization. Remember, market cap is really simple: number of shares outstanding times today's price. And you can see that when you look at any stock price online, you'll see what the market cap is. It's called market capitalization. So you can see, is it a big company that has a lot of liquidity, or is it a tiny company that maybe has more upside? It doesn't have as many shareholders, has a lot more price risk and volatility. You can also own preferred shares. Preferred shares give you a payout of interest rate. And should there be a bankruptcy, a preferred shareholder will get paid out before a common shareholder. So you're kind of higher up on the bankruptcy protection. Um, Stocks, you get a lot higher likelihood of return. If you look at the S&P 500 over long periods of time, average annual return are pretty close to 10%. Bonds are much lower, right? If you can get a 5-6% return over a long period of time, that's great on a bond portfolio. Less risky, less price movement. But here, stocks can change very, jump around. It's not unusual for companies that something happens in a bad day, they can go down 10, 20% in a single day. So there's a lot of ups and downs. The other things is some companies, not all companies, will give you what's called the dividend, which is a percentage of the stock price generally, and it might be 2% of the value of the stock paid out a year, and even some big companies, right? They offer dividends. Like Apple for many years didn't offer one, but does now. So dividends are something. If you own an S&P 500 index fund, you're probably getting a return of maybe about close to 1.5% a year just off the dividends being paid by those 500 companies that you have a little piece of through a mutual fund. Stocks are volatile, right? Over the long term, they go up. So here is the gray line is showing you the price of the S&P 500 through the end of September, right? So it's been on an upward trend, but you have some kind of bad times. So you can see if you look at that first kind of drop of 49%, that was the tech bubble, right? It peaked around March 1st of 2000 and March 1st of 2000, and it wasn't until around the end of 2002 that the bottom was hit. Then you fast forward, you go to the peak of the market October 9th of 2000. There was a very big drop, almost a 57% drop. That's the global financial crisis. And as you can see, it took a while, right? It took from 2008 to probably sometime in 2012. It's quicker if you do dividend reinvest so if you reinvest the dividends in your mutual fund, or if you have the dividends reinvested, if you buy individual shares of stock, you recover quicker. But look how big the increase has been. The stock market has gone up from the bottom of 2008 to the top of the COVID crash. It went up 401%. Then it crashed again, 34%. Then it went up again, 114%. Then it crashed another 25% in 2022. That was when the interest rates went up very quickly, and inflation. That's the inflation problem we had. The equity markets got hit as well as the stock markets, and since then, we're up 61, probably, probably it might be 65%, given what has happened in the past few days through the end of September, through November, but we're probably higher than 61. So the other thing is a thing called PE. Okay, so when you look at that box up top, you see a PE ratio, price over earnings, and basically that is the price of the stock, right, divided by 1 year's earnings of the company, right, per share earnings. So that's think about that as almost like profit, right? What's the profit of the company? So you're buying a company, and you're actually really buying the profits of the company. You want it to grow over time, and you can see that right now it's pricey. It's 21 times earnings of the S&P 500, and when you compare that to where it was before the crash, the housing bubble crash, the global financial crisis, it was 15.1 times earnings. So a lot of people would say Stocks are kind of pricey. The average over the last 10 years of PEs is about 18, and we're at 21. So there are different ways you can get out of that. One is stock prices increase. That stock prices don't increase, but their earnings increase. The other is there's kind of a collapse in the market, and you see a decrease. And you can see if you look back at the bottom chart, the lowest PE was 10. And so that's another thing when you're looking at stocks or you're looking into the S&P 500. If you're trying to understand, when's a good time to invest, it's always better to buy cheaper if you can. But if you're buying consistently and regularly, say every month in a 401k, don't worry about it. You're getting high prices, low prices. It's all gonna average out and just leave it alone. So that's I want to give you a little background on that. And again, the other thing is that some stocks are growth stocks and some stocks are value stocks. Best way to think about value, Warren Buffett's a value investor. Do you like to buy stuff when it's on sale? If the answer is yes, then you might be a value investor. A value orientation, and you'll see in mutual funds the name value versus growth. A value fund is looking to buy stocks maybe that they think are selling, the market's underappreciating the actual economic value of that company. Whereas a growth stock is looking for really big, fast growing companies like NVIDIA with the belief and the hope that they're going to just keep growing forever. And companies generally don't grow forever. So, so you're willing to pay a higher price to earnings ratio for a growth stock versus a value stock, and you can see that where the growth stocks today in the S&P 500 are selling at a PE of 28.6 times. A lot of that's being driven by big companies like NVIDIA. Versus value is selling at 16.7, but they're still below their long-term averages. You can see the yield that growth companies are less likely to pay dividends. So the dividend yield is lower, not even 1% from companies like that right now. Whereas if you buy value stock, they're paying dividends to you each year worth about 2.1% of your investing. The other thing just to know today is we're living in an unusual time. If you look at the right-hand side of that chart, the value, so the S&P 500 takes up all these companies, and your investment is it's on a cap weighted. So you put more dollars in NVIDIA, right? If you put $1,000 into that account, 350 and $80 are in the top 10 stocks right now. So if you look at that right-hand chart, you can see that that top 10% is very weighted to really big companies right now. That almost 40% of the money you put into an S&P 500 is invested in 4 stocks. And that means it's probably going to be a little bit more volatile than it was, say, in 2014 when that was less than 20. If something happens to these stocks, if they have an earnings surprise and drop by 15 or 20% in a single day. So when you see that high, that probably means you have more volatility in the stock market. So I won't get into much more than that on this deck. Individual investing in stocks, in bonds, is a hard thing to do. You got to love investing to do it. I wouldn't recommend you do it. I don't do it. It's I think a lot easier to use mutual funds. If you have a 401k account, odds are all your money are in mutual funds. Mutual funds are great. They're come in a lot of flavors. If you've heard of exchange traded funds, that's a type of mutual fund. Open-end mutual funds, you won't find, I won't get into the legal reasons, you won't find exchange traded funds in your 401k or 403b plans. And transactionally, they don't work. Instead, they use what's called open-end funds. Uh, if you're buying from a financial advisor, you should ask, are there any sales charges? Is it a load fund, meaning you have to pay that? They're getting money. There are front-end sales charges on some of these, or what's called 12B1 charges, which is about a 25 basis point fee up to a 1% fee that goes out of that mutual fund every year and into your financial advisor's pocket. So you want to find out how your financial advisor is being paid. I don't allow any of my investments, and I do use a financial advisor. I do not allow any of my money to go into load funds. I am not going to pay them that way. Um, there are active mutual funds where, um, excuse me, there are active mutual funds where portfolio managers are really trying to pick stocks and they're trying to pick the winners. And frankly, to be a good portfolio manager, if you can pick winners 53, 54% of the time, that's all you need. You'll have a good track record, but very few people can do that consistently. An index fund says, you know what, I just want to look just exactly like the S&P 500 index or some other index. Those are much cheaper. Active funds charge a lot more than index funds. You can buy equity mutual funds, fixed income mutual funds, money market mutual funds. There can be asset allocation funds, all sorts of different things, real estate, gold funds. There are now Bitcoin funds. You can only get them in an ETF, an exchange traded fund package right now. There may be one open-end fund structure, but most of them are ETFs. There are, if you want to invest with a social tilt, you look for things called ESG funds. That stands for environmental, social, and governance. So those will avoid certain things like investing in people involved in gun manufacturing, alcohol. They'll have their investing tied to people's environmental policies, maybe their carbon footprint, things of that nature. So you can also invest via mutual funds based on your social concerns. You need to do your research, but there are plenty of those products today in a way that they didn't exist, say, 10 or 15 years ago. So why mutual funds? They're professionally managed. Some of the largest asset management firms in the country, Fidelity, State Street, um, uh, Vanguard, BlackRock. I mean, these are giant $1 trillion plus companies and assets under management. They're affordable. They're liquid. You can literally sell these every day, and they will guarantee they'll give you whatever, if it's an open-end fund, you'll get that day's market value at the close of the market of every share that is in that mutual fund or bond. Exchange traded funds are sold on the market, but they have mechanisms that make it you get pretty close, very close to whatever the economic value of those bonds and stocks are. Literally at that nanosecond, you drop that trade into, say, your Schwab account or Fidelity account. So you can get great diversification. You can own internet. Yeah, you can own stocks, bonds. You can own domestic and equity, value and growth, and everything's in there in one package. They're convenient. They're incredibly highly regulated. The SEC has done a great job and relatively scandal free over for decades. There's been a couple of hiccups with things that have happened, but on the whole, people get their money. It's a very safe way to invest and a very reasonably priced way to invest. Make sure you understand, look for a thing called, there's a fee table in the prospectus, or you can look for the cost. Understand what they're charging you. And so, for example, this is an example of a fee table from one of the funds that I just pulled up. And the management fee, they're going to take out what's called, there are 100 basis points in 1%. So this is, 28 100th of 1%, 28 basis points. So basically, like a little bit more than a quarter of 1% a year is being paid to the investment manager. If you buy a Vanguard S&P 500 index fund, you'll maybe pay 5 basis points. There are other expenses that are required in here, but this whole thing is like 1/3 of 1% a year in expenses for owning it. Very inexpensive. And a great way to get professional management from really giant companies with great reputations. I do want to make sure I'm using this as an example. You might have Fund A that has a total expense ratio of 75 basis points, 0.75%, and this other one is like 1.85% a year. Well, what does that mean? It means that if I bought Fund Z, right, the 1.85%, that portfolio manager, because it's so much more expensive, has to generate 1% more in return than the first one at 73/4 of 1%. So, you don't want to really look at fees. You want the gain of the investment fund to go to you, not to the management company, not to your advisor. Make sure you understand how this all works. You don't have to worry about that so much in your 401k or 403b plans, or if you open up an individual IRA at Schwab or Fidelity. But understand, how much am I paying for this, right? Save yourself money. You'd be shocked if you can save yourself 1% a year, or 1/2 of 1% a year for 40 years, how much that compounds to you in your retirement account or your brokerage account or wherever it may be.
I'll hop in real quick.
Yep.
We do only have a few minutes left of actual presentation time before Q&A. So, and maybe this is a sign we need to have another session on this topic, but just might need to like hit the high points.
Yeah, so we got alternative investments are things like commodity funds or commodities. So think gold, right? Real estate, private equity, all sorts of things. Technically, these are investments. So is Bitcoin, right? Any crypto. The point I want to point out, how many times Bitcoin is very volatile. I just want to point out, look at the drawdown column, the second column from the right, how many times this has happened in a very short period of time. Bitcoin is not around very long, but it's had quite a few periods that make what happened in 2008, the global financial crisis, look, like a not so painful event. The drawdowns have been pretty incredible. And so if you're going to invest in Bitcoin, just know it's going to be incredibly volatile. It's a much more volatile asset class than equities. I'm going to skip that one. Asset allocation. I want to talk diversification very quickly. One way to reduce risk, right, is just have a diversified portfolio in bonds, in equities, in domestic equities, international equities, and maybe a commodity mutual fund. And so this is an example. You can see that gray line is the asset allocation. You're never at the bottom of the year's returns. You're never at the top. And what diversification does is it reduces the volatility of your portfolio. You're gonna have less strikeouts and less home runs. You're gonna have a lot more doubles and singles and maybe some triples. But you're gonna. I make sure I have an asset allocated portfolio, because that's a volatility level that I'm much more comfortable with. So you can get that through target date maturity funds, and that are very geared to your age specific circumstance, based on your retirement year. Use that date to drive which one you put your funds in. My guess is most of you will have them if you have a 401k plan or a 403b plan. And again, why international? Because everything you see where the blue line is below, international outperforms. We're going through a period right now where US domestic stocks have been outperforming international stocks for 13 years. That's really long. These things come in cycles. And my guess is we're probably about ready to enter a period where you'll be really glad you have some international exposure, because the domestic market may not be as good as it's been historically. Again, these things come in cycles. And you can see, different, look at this when you get the chart, but you can really see that global equity has performed very differently over the last 15 years in different countries. But there's every dog has its day, and there will be a period of time when the U.S. market doesn't do as well as it's doing right now, as has happened historically, going back to the post-war World War II period. This just shows you, again, volatility. And the good news here is the longer in time you invest, what you're going to have, whether it's 100% in stocks with 11.4% return over 20 years, or bonds with a 5.3%, or a 60-40, 60% stock, 40% bond balanced portfolio, 9.3% average annual return over the last 20 years. You can see on any given 1 year period, you can have some giant returns. Just look at that first bar green. The best year over the last 20 years was 52% return shortly after the bottom of that global financial crisis in a single year. The worst was 37% negative return in a single calendar year, right? So you can see these big returns. That blue bucket, negative 13%, that happened in 2022 when interest rates went skyrocketing. That's the worst post-World War II bond single year ever. So these things can, but if you look, if you go out 20 years, nobody lost money on a rolling 20-year period. So the longer you invest, you're much more likely to get returns. One way, again, if you don't want a lot of volatility, is more of a 60-40 portfolio. You give up some return, but you won't have those dramatic swings and losses. The worst it ever got in a 1 year period was 20%. Correlation, why have diverse investment? Why be in emerging market equities? Why be in European developed market equities? Why be in municipal bonds, corporate high yield bonds, commodities, real estate investment trust mutual funds, gold, all these things, is that the assets are not perfectly correlated. So wherever you see, if you just look at the first one, if two different asset classes are identical, the correlation is a 1. Anything less than that, so for example, municipal bonds are not highly correlated, but still move in the same direction as what would happen with the US large cap mutual fund, for example. But gold is not very correlated at all. By putting uncorrelated products together in an asset allocation fund, what happens is when one thing is going down, the other thing's going up. And that generally tends to happen with equities. When the equity market drops dramatically, usually bond pricing goes up because people are rushing into bond funds for safety, and the Federal Reserve reduces interest rates, which when interest rates go down, bond prices go up. So by putting diverse things together that are not perfectly correlated, that don't respond to the same market condition in the same way, you actually make your portfolio less volatile. So I'd highly recommend asset allocation because of the correlation issue and volatility issues involved. Inflation is going to hurt in every one of these cases. It's going to reduce your returns and we lived through that period. We've all lived through inflation right now. We know it costs more to buy everything, and so you need returns to be higher, and it's going to impact your equities. Equities are better with inflation than bonds. Bonds are not great in inflation. And real estate tends to keep up with inflation. Equities somewhat keep up with inflation. So I'll leave this. You can look at this on your own later. I really just want to go over retirement accounts. the big issue is, the big difference is whether it's an IRA, a 401k, or a 403b, you're going to have the ability to do a Roth IRA or a Roth 401k or 403b. And that's after tax income. You've already paid taxes on it going into your account. What's the benefit of paying the taxes? Well, the gain is never taxed. So if your account doubles in size just based on the growth of the investment, you don't pay a tax on that, right? And you also don't pay a tax when you withdraw the money. That's different than a regular IRA or a regular 401k or 403b, where you actually, what your contribution, say you put 3,000 in a year, you don't pay any income tax on that 3,000. And while it's growing, you don't pay any income tax either until you withdraw it. And when you withdraw that money, all of it, 100% of everything you put in is ordinary income. So when I started out in the industry, there were no Roth products. If I were a young person, I would probably consider doing the Roths. And the reason is any Roth product makes more sense if you think that in the future, your income and therefore your tax rate's going to go up. If you're going to have a higher tax rate tomorrow than today, you should absolutely use a Roth product. And it's more beneficial. It's much more beneficial the younger you are. It's less beneficial for people like me who are older. I'm 60. So it wouldn't be as beneficial for me, say if I retired at 68, than if you're 28 and you're going to retire at 68.
Got 1 minute left.
Yeah, I would look at the other taxable benefits, health savings accounts. Take a look at those. Those are unique. Your contribution is tax deductible. The growth is tax free. And the withdrawals have no taxes applied to them as long as they're for qualified medical expenses. These are great things to look at and to use if you have one available to you. I highly recommend them if you can afford them. 529 college plans, same thing. You can put small amounts in beginning when your child's born. I personally I've got 3 children. I opened one the month each one of them were born. And I can tell you the growth through the years of what I put in basically paid for 1 year of tuition for us for each child. So these are great ways of saving for events that you know are going to have happen. And how much you have to save each month is a lot smaller if you do it before they're a year old than if you just start this when they're 12. And you need to pull the money out beginning when they're 18. And with that, I'll stop.
All right, I know we're a little over time. There's no questions in the Q&A box. If anyone has pressing questions, we can try to answer some of those now. If not, definitely shoot us an email. This also may be the sign that we could use another session on this. Definitely, if there is topics that we had to breeze over that you want to learn more about, please add that in that feedback form you're going to receive via email today. That's a great way for us to know if you want to know more about a topic. I know we had to speed through some things today, so definitely let us know if there's something you're interested in, if you want to know more about retirement or about about stocks, anything. Let us know in that feedback form. Up next, we do have creating your personal finance plan, which is going to be kind of a compilation of all of the information that we've learned from these first 3 sessions, and then kind of using all of that to help build out a personal finance plan to help you take more control over your financial future. And I'll have a link to any of the recordings of the previous webinars in the email you'll be getting as well, if you wanted to kind of re-up on those, rewatch, or just watch for the first time. And other than that, I appreciate you sharing your time with us today. Again, feel free to reach out if you have any questions. I know we weren't able to get that today. We are here continuously to support you, and please let us know your thoughts in the feedback form and anything else you'd like to see from us. And thank you so much, John.
Yeah, thank you. Thank you, everybody, for taking your time to do this.